Hey, what's up? It's Greg here. How you doing? If you're new to the channel, we talk about business and investment. And on this episode, we're going to be talking about the bond market. Now, there's an old adage on Wall Street that says if you want to know or want to figure out what's going on in the stock market, look to the bond market. And the reason they say this is because the bond market frequently gives warning signals as to what may happen in the future in the stock market. So it's very important to understand what the bond market is trying to tell you. And in this episode, that is what we're going to be talking about. And it's coming your way right now. Okay, so most people who follow the markets and who are interested in investing, they typically follow the stock market. And this is natural because the stock market's always in the news, and it's interesting to follow companies and stocks like we do on this channel, for example. But one thing that is very important for you to understand in your toolbox of investing is to have a firm understanding of the bond market. Now, I spent a long time on Wall Street in the early part of my career as a senior investment banker with a major investment bank, and most of the transactions that I was involved with in the corporate sector dealt with bonds, issuing bonds on behalf of companies. So in my time on Wall Street, which was approximately 15 years, I gained a very strong background in the capital markets, and that's what I want to share with you now. You know, they say the smartest people on Wall Street are people who work in the bond markets. It is very mathematical. It's much more complicated business to understand than stocks. And frequently, I agree, the smartest people that I know are frequently involved in the bond market. So the question comes up now, what is the bond market telling us? And if you have been paying attention, you would have noticed that over the last couple of weeks, the long end of the curve, meaning the 10-year Treasury, has significantly gone up in yield. Now that means that the prices of those bonds went down because the market sold off at that part of the curve. Now I guess the first thing that's important to understand is that price and yield vary inversely. When the prices of bonds go down, the yield goes up, and vice versa. When the price goes up and there's more demand, the yield goes down. So what the market's telling us right now is money is going out of the bond market. Now, why is that? There are several things that are happening all at once, and I'll try and explain them now. First of all, the Fed has been, going out of control, printing money and flooding the bond market and the stock market with liquidity in the form of QE, quantitative easing, or bond buying of treasuries and other securities to the tune of $80 billion per month. This has had the effect of adding enormous speculation to the stock market. The stock market, in my view, is in a speculative froth right now and is way extended in valuation. But these extended valuations will not stop, in my view, as long as the Fed is incredibly accommodative, continues to print money, and also, combined with that, the government continues to just shovel money into the economy in the form of fiscal bailouts. So I think what people are focusing on in the bond market now is you just had the last Trump stimulus package, which is about $1 trillion, just slightly shy of $1 trillion. Now that money is going to be borrowed money coming from the Treasury market, and it's going to be flushed into the economy. And Biden coming in is talking about, I read in the paper today, is talking about another $1.5 trillion of more, quote, relief, which is just government spending, which is going to now be flushed into the economy. So what happens is people look at this and they're starting to say to themselves, okay, the economy's weak, we're in a recession most likely in the first quarter of this year, 2021, but with trillions and trillions and trillions of dollars of government spending being flushed through the system, all of this could increase demand, the demand side of the equation, which the pandemic has inhibited, but this could increase demand, and as a result, this could lead to inflation. Now, inflation is the enemy of bonds, right? Because if inflation goes up, the value of those fixed payments that you're receiving from those bonds in real terms, i.e. net of inflation, goes down. So those bonds become less valuable, therefore people sell them, therefore interest rates go up. Now, these inflation fears can be seen by this chart, where you can see that over the last 6 months, the longer end of the curve has risen steadily, and you can see in August 20th on this chart, the rate on the 10-year was 0.52%, and at the end there, January 13th, which is recently, it's 1.1%. So it's basically doubled since August, okay? The rate has doubled, okay? And in fact, since January 4th to the peak a couple days ago, the yield went up a little over 20 basis points, which is 0.2%, which is a very dramatic rise in less than a week. Okay, so something's going on here, all right? And the question is, what is it? Now, I think the easiest way to understand this is simply the enormous accommodation of the Fed, which everyone expects will continue, and the simultaneous fiscal stimulation from the government and basically, government spending. But this is excessive, okay? This is trillions of dollars. This is not just, a couple billion or billion here, billion there. You keep flushing trillions of dollars through the system and pretty soon you're talking real money. You know what I mean? So it's well-founded and it's understandable why people would start to fear inflation. Now, there's another thing to keep in mind that causes people pause and could be a big risk to the stock market. And that is, if the Fed begins to perceive that all of this fiscal stimulus is starting to overheat the economy and cause inflation to rise, they will begin to taper, right? You've heard taper tantrum. That's been used before in the past when the market perceives that the Fed is tapering back on its bond buying or its money printing. That will cause the market to pull back and pull back in a big way if they perceive that the Fed is pulling back significantly. So on this topic, let's take a look at one of my favorite analysts, and he's more than an analyst. He's a guru, a market guru, if you will, Mohamed El Arian. Take a look at this clip, and I'll come back and make some comments afterwards.
You wrote a piece over the weekend titled "Rising Treasury Yields Flash a Warning Sign." How bright is that warning sign right now to you?
It is getting brighter, but it's not that bright. I think the path of least resistance, Andrew, is still up. You've heard me say that for months, that the technicals supporting this markets are strong. But if you're looking for warning signs, there are some warning signs coming out of the fixed income market.
So, Mohamed, what do you think will be the tipping point? If you're looking at that warning sign to flash from yellow to red, what's going to do it?
So in the first 5 trading sessions, we've had a 20 basis point steepening in both the 210s and 230s. Said other ways, 10-year yields have gone up around 20 basis points. 30-year yields have gone up around 20 basis points, while the 2-year yield has been anchored really well by the Fed. It has been going up for the wrong reasons, not because of growth, but because of a combination of buyers getting more hesitant and people worried just about inflation, not about reflation, but inflation. So if that continues, if you get another 20 basis points in another 5 or 6 trading sessions, then it's flashing yellow a lot brighter at that point.
Okay, he said it's flashing, but it's not flashing that brightly. This is a warning sign that we should all be watching. We should all be watching the bond market. If yields go up significantly more, and particularly if they go up quickly in the future, this is a warning sign, and it's something that would be a harbinger of a rather significant sell-off in the stock market. Historically, if you go back to the '87 stock crash, for example, the '87 stock crash, which was one of the most severe in recent memory, or it's not that recent now, but within the last 50 years, there was a bond market sell-off right before that that was very severe and very nasty, and it was a harbinger of that sell-off, and there are many, many other examples of this. So I wanted to point this out as part of the information that you should keep in mind, keep it in your investment toolbox, so to speak. More will be coming your way very soon, and in the meantime, there are going to be 2 videos that I want to put up here that will continue to talk about it. Over here, I'm going to put something about Are We in a Depression, which is an interesting spin on what's going on today. And then also over here is going to be another video that you'll find interesting. And please like and subscribe so you can be on board for future videos, which will be coming your way very soon.